as you all know, accounting is probably the most amazing thing out there. It's riveting. People love it. And that's why you're all here tonight. But to be honest, it's probably one of the most important things. Nobody wants to get audited, right? No. And we always talk about it's not what you make, it's what you keep. So, big round of applause as we're going to kick off for David.
Thank you. Thank you. Thank you. All right. Well, yeah, hopefully you had some good networking and found some good connections, and I'm here to make connections too. So we're going to have a bunch of stuff that we're going to walk through today, talking about incorporations or partnerships, sole proprietorships, that sort of thing. We're also going to talk about what's changing in sort of the real estate realm within tax. We've got lots of new rules kind of coming up that Trudeau is putting in place, that sort of thing. So, and those are affecting us all over Canada, multi-provincial as well. So we'll talk through a couple of those things. We're also going to talk about the basics, just what can be deducted, what can't be deducted, what shouldn't we be deducting, that sort of thing. So we've got some tax landmines to come up to talk through those as well, but also some loopholes and maybe just some creative tax ideas. And that's always a fun one. Creative tax is kind of it's a misnomer, right? Nobody really knows about creative tax. We're not creative people, these accountants. But a little bit about me. All right, so business runs in my family. Yeah, that's good. So business runs in my family. My grandfather was a CMA. He had his own public accounting practice, just like I have as well. My mother was a bookkeeper. She worked for a furniture company in Edmonton here for 35 years. And then it came down to me, and I wanted to be a CA. So I got my CA, my letters through the University of Lethbridge. I also started working with Myers Norris Penny, which is a sort of larger national accounting firm. And after that, and I got my letters with Myers Norris Penny, I moved on and I started working with Stantec. I did some mergers and acquisitions with Stantec. So just kind of navigating North America, meeting up different engineering firms and buying them and then merging them into Stantec's sort of bigger regime. So that was a lot of fun and a lot of traveling. And then I became a financial controller for a pretty decent sized company here in Edmonton. It's a manufacturing company called All Weather Windows. I'm sure you guys have all heard about that and probably used some of their products. So that was super fun because they put me through all sorts of different education. One of those things being Lean Six Sigma, which was really great. And I really just understood the whole sort of manufacturing process of accounting. So that was a lot of fun. But what I really love to do is to meet with individuals like yourselves who are maybe investors, or maybe you've got a side business, or maybe you've got an incorporation that you're actively working in. Maybe you've got a retail store, that sort of stuff. That's the type of client I really love working for. So I started my own accounting practice. It was roughly 10 years ago. It was about 13 years ago where, practice, and I work with very much small businesses, typically incorporations, but we've got a lot of personal tax and a lot of more complicated version that it's, going to the Santa Barbara. A little bit about the firm that I've created. It's called Frederick+Sherwin. We're not creative when it comes to naming at all. That's not our creative side. But so lawyers and accountants, we always go with just our last names. Whoever's older gets the senior rights. So Jake Frederick, he's my partner, and he gets the naming rights on that, and I become a runner-up. But that's okay, because Frederick+Sherwin is a small accounting firm. We are general practitioners. We focus in on sort of this basic tax planning. Well, and if we need some extra help, or we've got a big GST,
excuse me, it's hard for us.
We've got sort of this specialty tax coming down the pipe that we're going to talk about. We get other people involved, right? So we are the quarterbacks. We are kind of the general practitioners, kind of like your general doctor is. We're not a large accounting firm by any means. We've got 2-3 partners, and we've got 4 staff. So that's us. We operate out of Sherwood Park, but we are not limited by any means to Sherwood Park or Alberta. Or what? Do I shake this? Is that what I do? I don't even know. Jen. Oh, see, I shook it. They're all gone. There we go.
Make sure they want,
I don't know what to do or what's happening. I'm not touching that thing. Are you kidding me? There's like 260 people on Zoom on this thing. I'm not touching this thing. Somebody else is going to fix it. Here's the champ. I didn't do anything. I didn't do anything. But we all knew that there's going to be some sort of technological issue. I shook the screen. Yeah, I did. I tried that. Yeah, no. All right, but we are a small little accounting firm. We love to really handhold with our clients. One of the things that we do as an accounting firm is if you guys have questions, anybody here on Zoom, anybody in the room, say you've been at the Mogul Mastermind and just ask me a question. Reach out to me, give me a call, send me an email. We love answering questions. We don't charge for that, right? We're not like a typical large lawyer firm. You don't have to give me a big retainer to get some questions answered. I want to answer your questions. We're not going to get through a lot of things today because we got a pretty short amount of time to talk about the entire Tax Act. But that's one thing that I really love to do. I'm going to change my slide. I don't know if that makes a difference, but we'll get into it. We'll get into it. So that's enough about me. We're here for real estate. We're here to understand how to structure our real estate, or what a good expense is, that sort of thing. So what qualifies as an expense? This is the biggest question that I get all the time, is like, Dave, can I deduct this, right? And the Tax Act really boils it down to something very basic. So the first section of the Tax Act talks about what qualifies as an expense, and it has to be incurred for the purpose of generating income or the potential for generating income, right? And that's it. That's what the Tax Act states. It's very black and white. And then we've got the rest of the book, which is a good 600 or 700 pages that talks about what you can and can't do. But the general idea is if you are incurring this expense in order to generate income or potentially generate that income, it's an expense. And then we go through Tax Act. So some of those things could be advertising costs. Like we're going to dial it into more of the real estate side of things. And it could be things like advertising costs, or even just basic office expenses to keep that real estate afloat. What else? It could be all of our condo fees or our lawyer fees, or unfortunately our accounting fees. It could be management fees. It could also, we're going to get into the creative side of things, but what about repairs and maintenance and hiring a related person? Maybe your son who's 18 years old, not in school yet, and doesn't have a job because he's an 18-year-old son. But that could be a potential area that we could take some of our parental high-level income and give it to our kids, right? So that might work. Insurance. Those are very general expenses. Now, in the real estate realm, like when we're talking about just sort of basic real estate, we can't deduct a home office. We do have a passive income. And so a lot of times people are like, well, I want to write off my internet because I'm running this Airbnb. It's just on the side. It's in my basement. You can't, you can't take your utilities of your home office and try to write those off. Things of that nature. There's also issues around traveling, recording vehicle expenses. Those are not typically a write-off if we've just got one property. That is a passive income approach. So there's some things that can be written off, some things that can't. It is a self-prescribed system, so CRA only knows what we tell them, and CRA only sees very specific things off our tax returns. And so if we want to sort of edge some things in there because we feel it's our right or what have you, then we can talk about that risk for sure. Another thing that is always an issue is repairs and maintenance, right? So we've bought this property. It needs a new garage door, or it needs a new roof. A new roof is a $12,000 expense. Can we write that off this year? Can we use that expense against and maybe create a loss on this property? Maybe we bought it in December and we have to put on this $12,000 roof, and we are going to not have any income this year. Can that roof be expensed against our $200,000 worth of employment income? Yes, it can. As long as that roof, when we're talking about repairs and maintenance, isn't a capital project. And being capital, it has to be new or it has to be a betterment. So we take it from a 25-year asphalt shingle that is now garbage, and we're putting on this same 25-year asphalt shingle, then that can be a repairs and maintenance. We can write that off 100% in that year. if we're putting on a rubber roof or we're putting on a tin roof and we're actually making a betterment and extending the life of that product, that is something that's going to be capital. Then we just have to capitalize it against the cost of our house, which kind of brings me to the next thing that a lot of people want to deduct. And so we buy this house for 300 grand. We put a $15,000 roof onto it, and we were creating a lot of income from this rental or this Airbnb or this rent to own, whatever sort of fashion that we're creating this income at. We're creating a lot of money. So now we don't want to pay tax on that. We're paying down the mortgage. Only the interest is going to be a write-off, not the principal that you're putting on the mortgage. That's not a write-off. That's actually growing your net worth. So that's not part of it. So we've got a lot of income there. People are like, well, I want to depreciate the property. And yes, we can depreciate a property. Okay, that is something that we can do, but that comes with a pile of risks. So we're just going to talk about that lightly now. I'm going to park that on the side, but depreciating a property is a potential. Okay, we do have to split out land versus the building side of the properties. So we do have to have a sort of evaluation or a reason as to why we did that, but we can depreciate a property, but it comes with a huge amount of tax risk. So it has to be done very strategically. Okay, and the last one is just talking in generalities about being organized. Being organized is one of the biggest and almost easiest things. It typically takes no time at all. But for 95% of my clients, they're like, I don't know, I don't have that receipt, or oh, that one fell out of the truck, or this happened or that happened. Being organized is super simple as long as you teach yourself to do it, right? And so kind of getting organized in that fashion. One thing that we do for a lot of our Albertan oil field type clients is literally have a Ziploc bag in your truck. Put the receipts in that Ziploc bag. When it gets too full, write on that bag. This one's July to, I don't know, September, and put it underneath your stairs. Pay for everything with a piece of plastic. Okay, we don't want cash expenses, that sort of thing. We want it through a bank statement or a credit card statement. If you've got a new business venture and we just bought that really crazy 16-plex, we're going to set up a separate bank account for that. We're going to set up a separate credit card. And then you took your other $1 million and you went and bought it some other drug lord 4-plex over here. Well, then we're going to set up another credit card and another bank account there. And then being organized is very simple. We're going to take those receipts. We're either going to put them in a digital fashion just by scanning them in, have a scanner even at the front of your house just to scan your receipts and then throw them out and burn them because we can keep things digitally, but they have to be kept in some sort of fashion like that. And one of the biggest things there is date stamped, right? As soon as we scan it in, as soon as we put it in Dropbox, or as soon as we keep that digital receipt, it's date stamped, which now that's perfect. It's going to somewhat align up with your bank statement, and your bank statement is going to create the financial statements for your accountant. And then you're going to give those financial statements, those beautiful financial statements to your accountant, and they're going to fill out your tax returns because it's going to be so simple for us, which is only just going to reduce your fees, right? So being organized, and I guess the reason that we're going to be organized is everybody sometimes gets audited, and that's a big no-no word, but people do get audited. And the biggest thing that we have to do there is walk through that tax return that I create down to those financial statements or bank statements that you guys have, down to those receipts, right? And CRA is typically not going to do a full audit on you guys. They're going to say, hey, why did you have this big loss this year in your rental? When you make 200 grand, that $12,000 loss that you created, you're actually getting a $4,000 refund off of that, right? So tell us why. And so then we would just go through the bank statements. We'd show them the rental statement, and we'd go down to the bank statement and find the 5 largest receipts, which is all that CRA is really going to ask for. And that's kind of it. So simple audits aren't that scary as long as we're organized. Okay, so that's just a little bit about organization. I know James, and he is a super organized individual. So if you want to talk to him about his system, he's got a great bookkeeping system for being organized. All right. I'm going to click this button. Nothing's happening. I don't know. I don't know why. No. Help. Single help. Yeah. The slides are changing. I want to be there. Okay. So what we're going to talk about next is we've bought this property or we're getting invested into something. And I don't really care what we're investing in. Like it can be an Airbnb. It could be a rent to own. It could be a long-term rental. It could be a flip. It could be any sort of real estate that you guys think about that you're getting into. And the question that we have to ask ourselves is, how is that going to be structured? Do we want that to be structured as our individual tax? So do we want to pay personal taxes on this and keep it nice and simple? Or is there maybe a trust that we want to impart into with other people, or maybe a family trust, which that's getting very specific? Or do we want to incorporate, right? Do we want to take this property, incorporate it with a Alberta or a BC or any sort of incorporation? Even a federal corporation could own property. Or maybe we've already have an incorporation that we're working with. We're making a pile of money in there. We've got some excess cash in that company. We want to use that to not buy mutual funds or buy crypto, which could work or not work, but we want to invest into some solid real estate. That's a great place to be investing. But let's talk a little bit about that. So on the personal side, things are super simple. It doesn't really matter that it's a passive income or an active income. And I'll talk a little bit more about that on the incorporation side, and that depends on the investment style. But on the personal side, we're subject to our marginal tax rates. And so you take all of your income, plus we take our income that gets generated from this rental, we'll just call it a long-term rental for now, or an Airbnb or whatever it is. And we take that income, we add that income to your taxable income. Then you pay marginal tax rates. So I'm going off of my mind here, but 0 to 19 grand is pretty much tax-free, so that's all good. But if your income's down in that level, we've got other problems and we're not buying real estate. But if our income's 19 to 45 grand, we're kind of in this 25% tax category. If we're in the medium level here, we're 45 to 95. We're in this 30.5% tax bracket. And I'm sorry, BC people, this is all Alberta rates. Your rates are much more variable. But they max out at a lower rate. So it's better to be BC if we're into these higher tax brackets. And then over 95 to 135, do we get there? Are we, no? I want to be on that one. But, over 95, then our thresholds really start going quite quick. And we've got these things that I refer to as Rachel Notley tax. Is that a swear word around here? Is Rachel Notley here? No, okay, good. But we do have Rachel Notley tax, right? We still got her kicking around. And BC, you've got your own tax issues. We can talk about that later. But so anything kind of over this $132,000 mark, we've got these extra 2%, extra 1%. If we're over $200,000 in our personal taxes, then we've got something that I call Trudeau tax. And that is our 4% high rate tax, right? So we've got Rachel Notley, we've got Trudeau tax. If our personal taxes are up in that realm, that's a problem. Maybe we don't want this investment property that we've got in our personal taxes. We want to try to shelter that somewhere else, right? So that could be a reason as to why we don't want this held personally. But if it is held personally, if we do want this to be, I'm going to steal my notes instead of the slides, right? If we do want this to be held personally, we could do some income splitting on it, right? So we could talk about, yeah, maybe our spouse and ourselves have anything that'll do. Maybe our spouse and ourselves have joint title in this property. So maybe we can elect to split some of that income. Maybe if we've got one spouse up in that $200,000 range and they're an employee, they can't get out of that income tax. They've used up all their RSPs. There's just no room to get down into lower rates. Well, then maybe we could identify our spouse, who's maybe a stay-at-home spouse, that they could take a lot of this investment income. We could split it 50-50. We could split it 80-20. We could split it 100-0, any way we want. But the first time that we take a property and we show our intentions to CRA as to how we want to split it, we should kind of keep to those intentions. We can change the allocation any single year, but that comes with high risk. On a personal held property. So we don't want 1 year, oh, it's a loss, I'll claim it because I'm the high income earner. Oh, okay, now we're into income. Now it's all the spouses who doesn't make any money. That's going to get us into a lot of trouble. So yes, there is some sort of income splitting opportunities when it comes to joint ownership or joint title, that sort of thing. But we do have to talk about where the money came from originally. So we've got some tax attribution rules, which we'll talk through, that sort of thing. The other thing, okay, so I'll move into sort of corporately. Well, no, I'll back up. On the personal side, again, it's very basic. We file our personal taxes. Any of our passive income here, if it's private lending or Airbnbs or whatever it is, goes on different schedules. It gets included in our income. We've got to file that. It's a January to December year end. We got to file it by April 30th. We may get an extension to June 15th, depending on what style of business it is that we're operating. But we got to pay those taxes by April 30th. And we're stuck with the money that we made in the calendar year. We're paying tax on that, right? So now moving on to a corporation and why we might incorporate. Corporations have a staggered year end. So the worst year end in the world is a December 31st year end. And I'm sure there's people in the room here with the December 31st year end. You'd be like, why? It's just so easy to navigate. And I understand it completely. And it's like, because I'm too busy. I am way too busy with December year ends. 50% of the year ends out there are December year ends. Trying to find an accountant in that timeline, you're just not going to get that sort of time availability. So that's one of the reasons. A better reason is we can save more tax with a non-December year end. If we have a January 1st year end or any day other than December 31st, I don't care what it is, we can make the same 12 months of income. And then I get to make a decision with you as to, okay, let's take some of this income into your personal taxes in December, and we'll issue a dividend maybe in December 31st. And then we're gonna spread some of that income out because we made a pile of money this year that we're not expecting in the future, and I'll issue a second dividend on January 1st. It's all within the same calendar year, a fiscal year of the corporation. So that's why we don't want a December year end. I call it income tax smoothing, which is not a word, but it's just a word I made up. And we can take that income and smoothen it over multiple years, right? So that's why we don't want a December year end, but we can sort of smooth that income out. Another reason as to why we might incorporate. So incorporations, especially in the real estate realm, have always been this way, where we've got sort of passive income, right? And that turns these corporations into specified investment businesses. And that's a horrible thing to be, because in an incorporation, if we've got passive income in there, we're subject to really high tax rates, 40-some% on that income, okay? But what it does is it triggers sort of this refundable tax. And if we issue a dividend to the shareholders, we get that tax back. So normal corporations on active income, they pay 11% tax under 500 grand of income, right? So a really nice low tax rate on that active income. On the passive income, we got 48% tax or whatever that number is, minus the refundable tax. We end up around this 16% tax. That's kind of where we end up in the corporation. But we're forced to issue this dividend to the shareholders, okay? So we're forced to take that income and basically pay the other portion of personal tax on it. So if we're in a relative marginal 40% tax rate, we're going to pay that 16% on the specified investment business income in the corporation. We're going to pay the other 24% on our dividends that we're forced to take. Okay, so that's sort of the biggest downside on sort of active versus passive income. Now, what is active income? What could active income be like? Well, if we have a bunch of real estate, we've got many doors, we're hiring lots of staff to take care of those doors, and we're actually hiring employees to take care of those doors. That could create an active income coming from real estate. If we've got one property and we've got another property that's an Airbnb all in a corporation, that's passive income. Maybe we've got some private lending in there too. That would be passive income. Okay, so Airbnbs, although a GST taxable supply, which we could talk about GST for another year, it's a whole other book. That Airbnb is still a passive income, and so that's a big question that I kind of get, saying, no, it's more active. I'm actively involved. I'm cleaning it myself. blah, blah, blah. It's still a passive income type. So it's still subject to the specified investment business income. So why then, I guess, what is active income? Could be multiple doors, could be lots of employees. It could be flipping houses, right? We are in the process of buying and flipping a house. That is a great place for a corporation to be coming into effect because we can make a pile of money in the incorporation. We can flip that house and whatever, make $1 million or maybe 500,000. Hopefully that would be a good number. We'll pay 11% tax on it. We'll have 89 cents left on the dollar to invest in the next property, right? If we are actively flipping homes on the personal side and our income's already in that $200,000 mark, we're paying a bunch of Trudeau tax, then we're going to lose 40 cents on the dollar. And we're only going to have 60 cents left to invest in that next project. So an incorporation in an active environment is a great place to make some money and keep most of that money and keep deferring that, keep growing our net worth and eventually retiring on that net worth within an incorporation, ultimately deferring a lot of the tax to that retirement years where we're hopefully in lower tax brackets, okay? Another great reason why we would want some investment income or some like a long-term rental, an Airbnb, I've got a couple myself, is I've got an incorporation already. It makes a good amount of money and I've got some excess cash in it. So things are going really well. I've used that excess cash. I've paid my 11 cents on the dollar on it. And then I went out and bought a long-term rental. So yes, I am subject to a little bit higher tax by about a 1% margin rate on that rental income in my corporation. But I used 89 cents on the dollar to pay for the down payment, to get them 80% mortgage and unconventional mortgage, all the rest within my corporation. So I'm not pulling out that $150,000 down payment, paying a pile of personal tax on it, and then trying to buy a house. I'm buying it within my incorporation. So that's a great place. If you already have an incorporation, you've got some excess cash in there that you haven't taken out personally because you don't want to pay high tax rates, then that might be a good reason as to why we incorporate some passive income into your corporation. Okay, I think that's kind of it for personal taxes versus incorporations for me. I want to talk a lot about a couple other things. So we've got some tips here and some landmines and also some things that are changing in our environment. And I'm going to rush through a bunch of this. So one thing I talked about originally was the depreciation of real estate. It's a great idea because in that initial year, we're saving a pile of tax. We can depreciate a property, the building property, by 6%. And so we can write that off. But the downside there is, yes, it might defer it for this year, but we do that 6% for 5 years. Now we've written off a good portion of that building. That building's increased in value by 2 to 5%. I heard inflation in Alberta is 5%. Way to go, Alberta. We're winning. But that inflation, so that building's going to grow in value. So now we bought it at 300 grand. We dropped it down by whatever, and we've depreciated it. When we go to sell it, then we've got to recapture all that depreciation. So when we sell it, we've got to take all of that income back in. And then that's a full 100% income inclusion. And then the capital gains on the growth of the property, that's going to be capital gains and taxed currently at 50%. Okay, so that's one of the things. Now I'm going to jump through a couple of slides because I know I'm taking way too much time here. So I want to talk about creative tax ideas. This is the fun part of things here. And I know we've got a Smith maneuver professional in the house. I was thinking, kind of going into this, I've been thinking a lot about the Smith maneuver. And if you've never heard of this, this is something to Google and then go ask your accountant about, or go ask your mortgage broker about. The Smith maneuver is about essentially using your primary residence where we are paying interest on our mortgage and not deducting it. So we got to make a pile of money, pay a bunch of tax, and then pay that interest. We're trying to convert that interest into a tax deductible item, basically. And so the Smith maneuver is kind of about leveraging ourselves or leveraging our personal house and finding that sort of using that HELOC, paying a little bit of interest in there, but taking that money and investing it into something else that's going to make even more money. And so a Smith maneuver is a great idea to implement. I was kind of coming here thinking, man, with HELOC rates at 7.2% these days, is the Smith maneuver still a thing? Is that still alive? And I think it is, but I think it's coming up with its challenges. But I've been told that there's still many opportunities there. So it's something that I personally need to navigate with. If you want to talk Smith maneuver, I'm definitely here for you. What I think is going to come back is what we call this self-directed RSP. You got a pile of cash in your RSPs. And maybe you're making money on them. In the last 6 months, you're probably not making any money on them. And we're also got these higher mortgage rates, right? We're paying 5% on some of our mortgages. Well, we could take that money out of our RSP, put it against our mortgage, and then we become the mortgagor of our own property. And we slowly put money back, and we make mortgage payments on that back into our RSP, plus interest into our RSP. It's a great idea. It comes up with a couple of sort of extra costs. There's a lot of professional fees, that sort of stuff that we incur, and same with your RSPs. There's going to be a lot of management fees there, but there could be a win, especially with rates coming up and still investments doing strong. So that's good. Now, talking about the Canadian working income tax benefit. This is one of my favorite ones to implement, and I mentioned it before. We've got this 18-year-old son. So we've got a real property, and it needs a little bit of work, needs some TLC. Well, who are we going to hire? Are we going to do it ourselves? Maybe, do we know somebody who's related or unrelated who doesn't make any money? Are they over 18? And are they not going to school? And they're not on any sort of programs, they're not on any subsidies or ACE or anything like that. Every Canadian here that's not going to school, 18 to 65, can make 10 to 15 grand in their total line 150. So we could hire our son for legitimate services and get him to go fix something, pay him 10 grand for it, and he's going to declare that as income. Because he's his own business now, he's a sole proprietorship running his own little company, and he made 10 grand, he's going to pay CPP on that. He's going to pay CPP, and his little company is going to pay CPP as well. So we got about $700 worth of CPP that he's going to pay on that $10,000 or up to 15 grand of income. But the Canadian working income tax benefit is for individuals who are not going to school, who are over 18, who aren't making a lot of money. And this program here is to effectively pay that CPP. And your son will actually end up with a tax refund, even though he hasn't paid any tax, of about $1,000. So not only do you get a $10,000 deduction in your whatever, in your corporation or in your real estate or in wherever, your son's getting CPP contribution or your daughter's getting CPP contribution, and they're getting a tax refund. So that Canadian working income tax benefit can be implemented, but it's got to be for real services, especially when it's related parties, that sort of stuff. I want to talk about income splitting through an incorporation. That is another option. So always when we are incorporating a company, we're talking about sort of the succession planning of that company. We want to talk about who's the shareholders, and the shareholders could be spouse and spouse. They could be friends. They could also be sons and daughters. There's a lot of succession planning style of things that way. So that's something that we really want to talk about. And that's a way that we can take this sort of family income and maybe spread it out to people who are in lower tax brackets. That's a little bit of a thing. And then one of the next biggest things that I'm being asked about a lot lately is our markets did really well. And so did our housing market do really, really well this last year. And we paid a pile of capital gains. Maybe we sold some properties, we sold some investments, and we have these capital gains inclusions at really high tax rates. Well, what's tax loss harvesting? And that's, maybe we've got a property, we've got like a terminal loss. We can use that terminal loss against our even employment income. But we could trigger some capital losses, maybe in our stock portfolio, and use those and backdate them to 2021, where we had some higher tax rates. So tax loss harvesting is always something that we're talking a lot about with our clients these days, and just how to implement that. And again, your investment brokers or even your sort of real estate portfolio needs to get involved to figure out what we can do there. All right, next slide, last slide, and then we'll jump into some questions. These are some tax landmines, and I'm not going to focus on them a lot, but they are huge landmines. We've got a couple of new rules that have come in place on the tax side. One's called this underused housing tax. It's the UHT 2900. It's a 9-page form. If you are on title or jointly held in title, or you've got a company that owns some property, you may have to file this form. Failure to do so by April 30th. This started January 1st, 2021. We're filing our first year's worth right now. It's due by April 30th. Failure to file here for individuals is $5,000. Okay. Failure for corporations is $10,000. And I think they're going to impart this pretty well. So we've got this Underused Housing Tax Act that has been instituted, and it comes up with huge issues. So if we've got properties held in trust, or we've got properties jointly held in corporations, there's a lot of different pieces here. We may have to fill out this form. If we own this property with some foreign residents, maybe we've got some US friends that are jointly holding this Airbnb with us. Now we've got to pay some tax on that property as well, 1% every single year, right? So this is very similar to sort of the Vancouver tourism credits, that sort of thing, or foreign people owning homes, not even foreign people, foreign BC people owning homes in Vancouver and Kelowna, that area. These are very similar taxes that way on this underused housing tax. So I encourage everybody, just Google that, or definitely talk to your accountant about it. If you are on title on a pile of properties, talk to your accountant about the UHT 2900. New house flipping rules, that's another tax landmine that's come into effect right now as well. You can no longer, buy a house, live in it for 6 months, fix it up, and sell it within the same 12 months. That's no longer allowed. That is 100% an income inclusion, and CRA will tack you with that. CRA's got full access into the titles office, and their computers are running away all the time. Depreciation real property, we kind of chatted through that one. That's another big tax landmine. If you have depreciated some property in the past, know that we've got a tax bill coming in the future, eventually, could be on death. And tax attribution rules, that one's getting quite specific, but that's allocating, we've got this income splitting opportunities that we've talked about, but we really also have to boil it down. Where did the money come from? Did it come from an active income from one spouse? Then technically, even though that has been tax paid on, we can't allocate that out to the spouse. We'd have to loan that money with an effective interest rate to the spouse. There is still a lot of ways that we can do income splitting, even though they've really canceled that on us. But because we've got these sort of statute loans that we could give a spouse, they can use that to invest into property as well. So it's still a great way for sort of income splitting. But tax attribution is another question for your accountant or for me. And I'm here for any of your questions. I really appreciate your time. That was a lot to kind of go through. I could talk days about tax, that's for sure. Yeah, Kevin knows it. He's nodding his head. So, but if you guys do have any questions, I'm here for you, or on Zoom, you can land those questions in, or also I hope my contact information is in there, and feel free to contact me anytime. I did this speak last year as well at the Mogul group, and it was great for me. People have been contacting me throughout the year with their questions, and that's what I love to do for my clients. So again, thank you very much.
We'll keep you up for some questions. Awesome. Thank you so much, David. Okay, let's open it up for some questions. All right. First hand up. So we'll just repeat it back so people can hear online. So his question was, can he legitimately hire his kids for lawn maintenance, snow removal, basically anything around the property? And does he have to declare CPP and kind of all the things that go along with that?
Yeah, and that's a great question. So hiring a related person, somebody that's close to you, or bloodline, that sort of thing, it has to be a real service. It can't be a made up $10,000 bill just because I told you it should be 10K. Okay. But if we've got real service and we're paying them a real dollar rate per hour for those services, all they need to do is invoice us. Now they've got a side business. Any side business is any hobby really can be a sole proprietorship. They don't need a trade name. They don't need a business. They don't need a GST number because they're under that $30,000 threshold. They literally just need to invoice us. So we've got a copy of that invoice to deduct for taxes, and we need to pay them. If they give it back to us in groceries or whatever, that's fine. But we do need to actually pay for that invoice out because that substantiates that expense as well. And then they've got a sole proprietorship. When they fill out a T2125 on their personal tax returns, that goes through their sort of income, and they will pay CPP on that. But that's where that Canadian working income tax benefit can create a benefit. I had a question over there, and we'll come to you. Yeah. Yes. Oh, that's a great question. Yeah. So the question was, with depreciating property, we do have to value the land specifically that's undepreciable to the building that's on the land, which is a depreciable asset. Okay. So the question is, we've got a property here at 300 grand, and the land was worth 50 and the building was worth 250. It's always kind of goes that way, that the building's worth way more than the land. But that's where the valuation came in. We've depreciated that building down by 30,000. So now it's only worth 220, and that land is still worth 50. Now, 3 years have passed, and that building's now worth, I'm going to come up with numbers that are going to hurt me in the next step here, 330,000, right? And so how much did is the land still worth 50, or is it worth 60? Or is it worth 57,602? Nobody knows, but we do need a valuation on that. We need a reason as to why we came up with that math. And so typically what happens in that calculation is we would take, the percentage that the way went from 300 to 330, we would apply that percentage to the land as well. And then we would apply that percentage to the building. So again, when we get that recapture of depreciation that we've taken over the first 3 years, that was 100% a deduction in those 3 years. Now it's 100% inclusion. The problem there is it might bump us into higher tax brackets. So we're paying higher tax brackets now versus later. So that's why it's a very strategic thing. And then the capital gains from 300 to 330, that's currently a 50% tax inclusion. That hasn't always been a 50% tax inclusion. So that's also something to be cautious about. Every year, the budget talks about changing that capital gains inclusion rate. Okay, so that is coming in our future. The UHT? If the property is personally held, no, that's not a problem. If our construction timeline goes over a year, yes, that could be a problem. So and a year is 12 months, right? Not just a December calendar year. So no, if it's personally held, we are fine with. It's not necessarily this term underused is kind of a really silly term. It's not about properties that are just sitting there. It's all real property. So yeah, but if the property's vacant for 8 months or we're renovating it or anything, that's totally fine as far as the UHT 2900. Yeah, and if that's, however we've come up with our profit and loss, we're going to be maybe deducting some of those renos that we're doing. Maybe we're going to be capitalizing some of those renos that we're doing. That's probably going to be a year of a loss for you for sure. And if it's personally held, we want to be sort of strategically using that loss against higher levels of income, right? And we can carry forward that loss as well if it overrides sort of your employment income or other sources of income. But great question. No, it doesn't. So your principal residence is individually owned, and you are a Canadian citizen or a permanent resident. You would be there. Yeah, can't remember the term, but exempt from filing a UHT. And I should just repeat. What was the question? The question was, again, sorry. Does the UHT form apply to personal residences? And that would be the thing. So no, if it's personal, you do not need to be filing anything. You are exempt. Yes. So do you have to file the UHT if you hold rental properties under a holding company? So the title is under the holding company or in any corporation? And the answer is yes. Do you have to pay the tax or not? That's a different question and likely not, but it doesn't mean you're exempt from the filing of the UHT.